There's a tax saving hack that the wealthy use, which helps them reduce their tax liability from 30% down to just 3%. And I'll tell you exactly how this works. This requires people to set up entities across 3 countries: UAE, Mauritius, and Singapore. UAE, they choose to be physically present in and be residents of. Mauritius is what they use to set up an entity which does investments around the world and even in India. And Singapore is where they set up a business entity and a bank account. And I'll tell you exactly how this transaction works. Imagine you're a person who's a consultant or a freelancer and provides services from anywhere in the world, but to foreign clients, say clients sitting in the US. So you decide to move to the UAE and become a non-resident for tax purposes from an Indian point of view. So you're living in the UAE and you provide services to US clients who pay the company which is located in Singapore. So the money is received in the Singapore bank account. Now, Singapore does not charge taxes to foreign sourced income, so you pay zero taxes in Singapore. But the Singapore company is actually held by the Mauritius company. And at the end of the month, the Singapore company pays the amount as dividend to the Mauritius company. And in Mauritius, the company pays just 3% dividend tax. Now, this entire amount which is available in Mauritius can be invested somewhere and can be used by you to meet your living expenses. So a small amount which forms your salary is sent by the Mauritius company to UAE so that you can meet all your expenses, and this salary is not charged to tax in Dubai or the UAE. And all the savings that you've made in the Mauritius company, you can also invest in assets in India. Think stocks, startups, angel investments. But why have you chosen Mauritius to do this? Well, because of a very interesting clause in the India-Mauritius Tax Avoidance Agreement. Now, what does that clause say? Well, if you are a non-resident and you hold assets in India, when you sell those assets and you make long-term capital gains, that long-term capital gain can only be charged to capital gains tax in one country, which ends up being Mauritius. And in Mauritius, that tax rate is just 0%. Now, this is completely legal and you file your taxes in India as a non-resident. You live in the UAE, your business runs in Singapore, you can make capital gains, sell those assets, and the only tax you've paid is actually just 3%. Now, of course, there is a lot more nuance to how to structure this, but for this to make sense, you should ideally have incomes of upwards of 1.5 crore rupees per annum to make this work. A lot more in the description. Share it with someone who may need it.